Hello, everyone. I hope you're ready to look at some Blink charging stock. Obviously, an old position of mine, so I'm familiar with this thing, okay? I know this beast. We're going to talk about it today. Just reported earnings yesterday after hours. You see the reaction. Started off a little bit negative pre-market, obviously. Post-market was a little bit there, but now it's actually in the green right now for the day. So, interesting stuff. Obviously, market just kind of opened about 30 minutes ago, so already in the green now. Let's look at these earnings. So, Blink charging here, quarter four GAAP EPS of negative 24 cents is missed by 12 cents. Not a shocker here. Company's not profitable, nor is it necessarily headed right toward the path of profitability. They're not there yet. They're not there yet in their growth cycle. The revenue line it's a big increase, but we're talking about a revenue of $2.5 billion. $2.5 billion or 2.5 million. 2.5 million, which is an increase of 257%. It beats by 0.7 million, so it's quite an increase for sure. But you look at that, and I think you look at that revenue line, and you have to already question yourself, okay? $2.5 million. I just want to say this is obviously one quarter, but this is a company right now trading at a $1.5 billion market cap. Yet, based off of these numbers, this company is probably it's definitely doing less than $10 million. We'll look at the full year report as well. This company's going to be doing less than $10 million. Yet they're going to be trading at a market cap of $1.5 billion. This has to be the most overvalued stock I've seen in my life. And I personally got to partake in the ride up, If you look over a year's period of time, I got to partake in this ride up. I really did. And this thing was valued even higher before. We're talking about a 52-week high of $64. What? I mean, that's incredible. This thing, I got to enjoy the ride. I really did. But there's no doubt, I can't argue this is the most overvalued stock I've seen nearly in my life. It's rough out here, okay? It's rough. There's a chance, if there's a downturn in the market, this is one of the stocks that's going to get absolutely clobbered beyond belief. So keep that in mind when you look at this stock. So Blink makes continued progress with its owner/operator strategy. The company notes that the number of commercial Blink-owned charging stations grew 51% year over year during the quarter. Total revenue, obviously, $2.5 million. And words from the CEO, the stock isn't valued where that's what he should be saying. But Blink's unique owner operator model is a key differentiator in our industry. With this model, we realize an economic benefit with benefit each time a vehicle is charged at a Blink-owned unit. As EV adoption continues to grow and utilization of chargers increase, we expect Blink-owned units will represent a valuable recurring revenue stream for many years to come. Now, the problem with that, and I think there's many things you can comment on that with his statement there. There are positive outlooks in the future, no doubt. I mean, there's no doubt that this company is on the forefront of a very important industry. Because when you look at the future, electric vehicles are going to take over. Now, the question becomes, when is that going to be the case? When are traditional ICE vehicles going to be outnumbered by electrics, and when are they going to be completely taken out of the system? For the most part, obviously, if you're talking about the time that we have zero ICE cars, you're going to be talking about a solid 40 years down the road. Let's just be clear with each other there. Because people will always be driving their vehicles regardless. Even if they stop manufacturing, people are going to be driving those vehicles for a long, long time, unless you completely force them to stop, in which case there's going to be some issues with that. As far as what electric might outnumber, I think we're still looking. I don't think there's a doubt we're still looking 10 to 15 years down the road. So this is a very far-fetched idea here that that is causing this stock to go bonkers. But let's look at the press release here. Let's see what we got. Fourth quarter revenue grew to 50%. Full year grew 121. 1,100 commercial and residential EV charging stations were contracted, sold, deployed, and acquired during the fourth quarter. It is good to see that. There's no doubt. And they raised $225 million in capital in January, providing significantly resources to drive long-term growth plans, but also a significantly higher debt. And we'll look at the balance sheet and see what we have going on there. I'm not going to expect a good look. Let's just be clear with each other. As far as fourth quarter strategies, we pretty well saw what we saw, but we saw product sales as far as the chargers came in at 1.8 million compared to 0.2 of the fourth quarter in 2019. So again, massive growth, but it's just natural. The percentage is going to be quite the growth when you're not even making $1 million. So revenues from networks and fees at 0.4 compared to 0.1 million. Revenues from downloading services, revenues from charging services decreased to 0.2 million as compared to 0.4 million of last year. They're blaming the pandemic, but again, this is where we get an issue. If their main statement's going to be the recurring revenue model of the charging station, the charging services, this decreased by half. It wasn't even at $1 million before, and it decreased by half already. I mean, they're going to blame a pandemic if they want, but why would the pandemic mean people aren't charging their vehicle? It doesn't mean that at all. You have more products out there, yet people aren't using them. So, I don't know. That's my point on that. It's just, I don't know what's going on there. That doesn't seem right. Net loss came in at 7.9 million and diluted net loss at 2.9 million. Never mind. There is no diluted at all. No, not at all. 7.9 million compared to $2.9 million loss in last year. So as they continue to grow this company, oh gosh, that's terrible. Total revenue for the year was 6.2 million, yet the net loss for the fourth quarter was 7.9 million. They brought in $2.5 million and lost $8 million in net loss. That's horrific. I don't think anyone could argue that is a horrific number, and it's doubled year over year. Now, again, they more than doubled their revenue, so you can make a statement for that if you want, but this is a company that can't afford that. That's why they're going to need to continue to do capital raises when they're going to have a net loss of that number. Not good to see. Total revenue for the full year, 6.2 million compared to 2.8 million. And again, the main thing I want to point out here is charging services. 0.8 million compared to 1.4 million of last year. That's just not exciting. I mean, for the full year, you decreased in charging services, which you're flaunting as the future of the business. People aren't charging their vehicle less because of the pandemic. It's just not a thing. It's just not the case. It's just not good. Net loss for the full year at $17.8 million compared to 9.7 million. I mean, they doubled it year over year. There's no way to say it. It reflected increased expenses related to the company's anticipated growth. Just not exciting for me there when you're talking about $17 million in loss and a net revenue of only 6.2 million. Not exciting. Business updates. I mean, they're gonna try to say everything they can about positives here. We're gonna look at the balance sheet here, year-over-year comparison. Believe it or not, this is just the balance sheet. We're not talking about anything that's super exciting here. So you can definitely see massive capital raises here. Total current assets here coming in at 26.2 million. Now that compares to 10.1 million of a year prior, but the reason is because of a massive capital raise. You see this cash number, they are hoarding some cash right now for expenses. I get that. Total assets in general coming in at $34 million, $34.5 million, compared to $12 million of the year prior. So quite the increase, but again, it's all due to this current asset line. Now liabilities, we got to look at that, no doubt about it. Total current liabilities sitting at $6.7 million compared to $4.3 million. Not that big of an increase compared to what they did in terms of cash and cash equivalents, I can't lie. And total liabilities in general at $7.3 million versus $4.5 million. Again, not as big of an increase as you might have thought. Personally, I expected a lot different results here. No doubt. Again, accumulated deficit, not exciting. A lot of deficit on this company, $187 million. That increased for sure, but technically stockholder equity did grow quite a significant margin here. 27.1 million compared to 7.4 million. Technically, this is a decent looking balance sheet for the company. Now, accumulated deficit, I don't like to see that. I'll show you that number, not exciting, but the overall equity here, quite an improvement. So I will say that's one thing that's got this company, rolling here. That's good to know. But again, my main thesis here, it stands true. You're going to trade this company at $1.5 billion off of a full year revenue of $6 million. Let me just, you need to know this. You need to know this. You need to know what this is. 1.5 billion, by the way, divided by 6 million, by the way. We are talking, now this is rough here, okay? Some may not think it's possible. 250 times the market cap here. 250 times. The market cap is 250 times what they brought in revenue. That is what I call extremely overvalued. Look, I'm not saying the stock's necessarily going to drop significantly, but it's just completely out of control. I don't know. This is not something I believe is accurate. I don't know what we're doing here. Not that exciting. Blink, I'm not saying sell because, again, this market's crazy, but I'd say there's no reason to buy the stock at this level. No reason. You'll be just asking for loss, okay? Have a good one.